Next, it is a IRM, that is a integrated risk management. Integrated risk management. What does it mean? Now let me tell you that we basically read about the different risks types, whether it was a case of the credit risk, it was a case of the market risk or operational risk, and also there are other risks which are also there in the banking portfolios, whether it is the interest rate risk or the other types of the risk. Okay, so all these risks are related to each other. All other risks are related to each other. It may be the case that one risk is leading to the other one, and further there also changes the degree of the other risk. They are also altering the degrees of the other risk. So on the whole, we can say that all the risks have a combined impact on our earnings. They are having a combined impact on our earnings, that is a adverse impact. That is a adverse impact of earning, and further they are lowering our earnings. Okay, so we can say on the whole that the different risks are there which we are basically having in our banking portfolio, whether it is a credit risk, market risk, or the operational risk, or any other type of risk which is associated. And also one risk type leads to the origin of the other type of risk, and also it can alter the value of the other type of risk in a better way or in a adverse manner also. Now that will basically lead to what? That will basically lead to the adverse impact on our earnings. Okay, so the ultimate focus is on the earnings itself, because we are having the deteriorating earnings if we are basically having this particular risk. So these all risks must be dealt with equally. These all risks must be dealt equally, and that is the only funda. That is the only funda that we are going to learn under the integrated risk management. Okay. So integrated risk management is related to managing the all risks which are associated with the activities so undertaken. Whatsoever the activities are undertaken, there is risk associated with it, and we are going to manage all these risks. Okay. And further, it is related to common factor in all these risks is the downside impact on the revenue. So the common factor is all these risks are going to impact our portfolio and further impact on our revenues, and further there would be downside potential. There will be downside potential, but because whenever we are talking about the risk, it is related to the adverse effect, not upon the upside effect. We are going to take the adverse impact only. Okay. Then profit and loss of an organization is the sum total of all the profits and losses. So when we basically figure out the profit and losses, we'll be doing what? We'll be basically taking the profit from different activities, and further we'll be basically aggregating the losses from the different activities, and we will be just having the algebraic sum of those so as to reach out that we are having the net loss or net profit. Okay, same is the way with the risk factor itself, whether we are having risk related to the credit risk, market risk, or the operational risk. Now ultimately we are going to figure it out that what risk is there, what is the integrated approach based to that, how we are going to deal with this. That is related to what? That is related to the integrated risk management. Okay, so net effect of all risk may not be the same. The net effect is not may not be the same as sum total of all this risk, because of the diversification effect of the risk. Now the diversification effect is there related to the different risk over there. As I already told you that these risks individually do impact the portfolio, and also they play interplay. They do interplay. Okay. It means what? It means that one risk is impacting the degree of the other risk too. Okay, so that is basically they are altering the other risk factors too. Okay, that is why it is said that the sum total of all the risks may not be the same. So let us take the case that you have basically you can say measured that there will be a probable loss of 50 crore by credit risk, 40 crore by market risk, or 30 crore by operational risk. The sum total comes out to be what? The sum total comes out to be 120. But it may also be possible that your total losses, the total probable loss may be greater than 120 because of the interplay of these risks. Is that clear? Because of the diversification effect. Because of the diversification effect. So inter-firm comparison between the firms on the basis of the profits or profitability ratios does not provide the clear picture. If you're not taking the risk levels or risk events into picture, you cannot basically identify, you cannot basically compare the two different firms. Okay. Next, it is related to the risk related capital. Next, it is related to the risk related capital, that is a capital that is commensurate with the risks that the organization carries is also a factor that needs to be taken into account. What does it mean? It means, as I already told you, that the different risks, if these are added up, the different degree could be there. Even though you add up them all, the different degree could be there due to the diversification effect. And also you are maintaining the capital for each of the risk. So that is also one of the factor that must be kept into mind. Okay. And higher the risk means more instability is there, and further more instability means more capital is required so as to absorb the losses. Is that clear? That is the first point that we read in the case of the risk management, that is related to variations. So it means what? That means higher the losses you are having, then it means higher the variations. Higher the losses, it means higher the variations, and higher the variations, higher the capital is required so as to absorb these losses. So as to absorb these losses. Is that clear? Further, risk adjusted return on capital. Risk adjusted return on capital is critical, and further integrated risk management assumes an important role over here, because you are talking about what? You are talking about RAROC. You are talking about RAROC, that is risk adjusted return on capital. That whatsoever return you are going to calculate, you must be having a risk adjusted return. You must be having a risk adjusted return. By now we calculated the different risks and we quantified the different risks, and further we quantified the capital to be maintained for those purposes. But if the net effect is even greater than that what we were having, the individual impact, in that particular case more capital is to be maintained, and further there will be a extra burden. There will be an extra burden on your earnings, and further that must also be accountable. That must also be accountable. Next, it is related to the necessity of integrated risk management, that why it is necessary. Why it is necessary? First of all, it centralizes the process of supervising risk exposure so that organization can determine how to best absorb, limit or transfer risk. So in case of IRM, that is integrated risk management, you're basically focusing on the whole institute itself. On the whole institute, on all the activities, that what would be the net impact of all the risk. Okay, so it centralizes the process. And second one is related to, it can also help in finding ways to capitalize on the upside potential of the risk, that how we can basically reduce the downside potential, and further we can say that how we are going to increase our earnings. Okay. Third one, it is related to do that the organizations must thoroughly understand the processes of risks in order to make the informed decisions. So the organizations must be having all the aspects related to the different type of risks, and further what is their interplay, so that they could take the informed decisions about retaining, financing and transferring of the risks. These decisions require a standardized, integrated approach and further integrated reporting, so that the organization always has a consistent and timely view of its exposures. So it should not be like that you are maintaining the credit risk differently, market risk differently and operational risk differently. There should be a centralized approach, that how you will be dealing with these type of risks. There will be a centralized approach. So when properly implemented, the integrated risk approach, it aligns the strategic aspects of the risk with day-to-day operational activities, and further facilitates greater transparency. So greater transparency is there, that is also true, and further it enhances the revenue and earnings growth. Definitely when you are managing all the risks well, in that particular case, that increases the upside potential and further controls downside risk potential. That is true also. Okay, so if you're basically properly implementing the IRM, that is integrated risk management, in that particular case you align yourself, that is related to the strategic aspects, and further you facilitate greater transparency is there. You are basically increasing your revenues and earnings, and further it basically controls the downside risk potential too. It controls the downside risk potential too. Next, it is related to the IRM approach. So the process of the integrated risk management relates to what? It related with the strategy. First of all, it is related with the strategy. So integration of the risk management as a key corporate strategy. First of all, we must be covering it as under our strategy, that it must be a corporate strategy. It must be a key corporate strategy, that we want to integrate all type of risks so that we could focus in our day-to-day operations. And further, establishment of the chief risk officer position. establishment of the chief risk officer position with his or her accountability to the board of directors. Third one, it is related to process. The process of identifying, assessing, controlling, financing risk must be common across the whole enterprise. Okay, it should not be like that. For some particular activity, you are using some different model for calculation of the risk, and for some other activity, you are using some other model so as to quantify the risk or identify the risk. Okay, so the same methods, processes must be used so as to identify, quantify, assessing, controlling, and monitoring the risk across the whole enterprise. Then it is related to system. So risk management system must be developed to provide information and analytics or analytic tools to support the enterprise risk management function. So whatsoever systems you are using, those systems must be developed in keeping in mind that those provide particular information related to all the risks, so that we could take a informed decision. And further, the analytical tools must be there so as to support the enterprise risk management functions. Okay, so that is related to the IRM approach.